So let's say you are looking at the 4 hour here. We do have our higher high, higher close here. First thing you're looking, or excuse me, lower low, lower close here. First thing you're looking for is that pullback, which you see we're starting already here on the 60, right? So we have a previous level of structure support, which was violated. We're now pushing back up in the previous support, looking for it to act as resistance. And you're asking yourself, how can I get involved, right? So let's go one more time frame down to a 15, because we're not going to get much yet here on the 60. 15-minute time frame. You can see that we've come to a previous level of structure here. We've held at that level. Now, zero, I don't see any entry reason or anything like that. We haven't gotten much at this level, but this would be the first level where you would look for shorts, right? With a nice, easy stop loss above this little structure hump right here, and a chance, an opportunity to trade it down to the lows, and of course the extension. Now again, did we get any entry signal here? None in my book. So that's the part you'd have to figure that part out on your own. But that's the bearish opportunity for you. Perhaps we go down to a range bar chart. Maybe it chops some of this up, gives us a little bit of a different story. An 8 range would be equivalent to the 15. I guess if you went down to a 5 range, which would be most likely equivalent to a 5-minute chart, you do have your lower low, lower close right here. You do have your double top. So that could be an entry reason for you. So for a short-term day trader on a range bar chart, you're looking at a situation where if you're looking at a double top, you've got the perfect entry right here. You've got stops 26s minimum. Minimum stops at 26s. Maximum stops at 31s, depending if you're using a 1 to 2 ATR range. And then again, you got your test of the VS1 down here. So you put yourself in a situation where you have either a risk reward that looks like this or a risk reward that looks like that to target 1. I'm going to thicken this up as well. Bobby says hidden divergence 2. Which line did I just choose, Akil? So you're putting yourself in a situation that looks like this. As a range bar trend trader. I missed the range bar trend trading days. Again, conservative stop like that. Aggressive stop. Looking like this. Bobby says hidden divergence. Let's take a look at this bad boy right here. Yep. We're shooting for targets all the way down at 89. 89 evens. Down to 88 fives. Right? This is a long way. But again, what you would do here is you would just actively manage your trade. So as the market, if the market ebbs and flows down, right? We take that stop loss and we trail it and we trail it and we trail it. So we lock in profit on the way down. If the market gets all the way to our destination, then hey, it gets to our destination. If it doesn't, at least we're stopped out for more profit, right? Another option would be to have maybe a more conservative approach. And of course, there's many options within it, right? You don't have to be a 2 target taker. You could be a 1 target taker. You can be a 5 target taker, right? You can split up your position however you want. So there's endless options. But another option would be take your Fibonacci extension tool from the swing high, right? This last move that broke out to our swing low, and use some fibs, right? Say, hey, a 127 could be a target taken area. That can also be a target 1 taken area if you're a true trend trader. Again, I'm not a true trend trader, so I had to take targets here. On regular charts, range bar charts, I could be a true trend trader. On minute-based charts, I could not. But you can look for a 127. You can look for a 1618 as well. Hey guys, I want to come in and do a little bit of an update on one of the trading opportunities we looked at this morning in the live room. And this was the Aussie yen continuation opportunity, where you remember we were looking for a continuation down to really a lot lower, but from a day trading perspective, we picked out a few different levels. Now, you're looking at it right now and it looks exciting because you're saying, hey, price action broke below that VS1 level. We traveled right to the 127, which was the very conservative target. And then we're continuing to make our way down to our lower target levels. However, the one negative was this. If you look at the move that it made, price action actually made a complex pullback. So a multi-legged pullback on the way up. And it looks like that multi-leg pullback would have stopped you out of the trade. Remember, we're on the range bar chart right here. So we talked about a conservative, or I guess an aggressive 1 ATR base stop, which would have been, I'll kind of adjust these a little bit right here. And then a more conservative 2 ATR stops, which would have put us right at 90.30s. And guess what? 90.30s was hit. And these are stinker types of trades, right? These are ones, obviously, you want to take note of it and make sure this is not happening on a regular basis, because if it is, you need to make slight adjustments to your stop losses. But sometimes you're going to have opportunities like this in the market where it just sucks, right? You make the right prediction, but price action just skunks you out on the way. But the reason I want to bring this up to you is because the other day, I'm not sure if I put this on YouTube or not, but we spoke about this in the live room. The other day, it might have been a YouTube short, actually. Anyway, the other day we talked about trend continuation traders and kind of the mental battle that trend continuation traders have to go to, where there's two types of scenarios in a trend continuation trade, right? So we have our basic, initial structure low, our outside return, our new structure low, and then we're looking for a pullback right into our previous kill zone, the area between our initial structure low and our previous outside return. And we spoke about two different ways trend traders can handle this. One is just saying, hey, once I get my signal, wherever that signal may be in this level, I'm going to take my signal right here. I'm going to look for a short to catch the next extension. I'm going to put targets above the invalidation point, which is the previous outside return, because we know if this previous outside return is invalidated, our reason for trading is invalidated, and we should want to be out of the trade. Another method is taking multiple swings, right? So this is the one where you would take a swing and you just have a pretty much a larger stop loss that you can feel really safe about. The other one is taking multiple swings, basically saying, hey, I'm going to look for my entry reason, let's say right here. I'm going to put a stop loss right there. And if price action stops me out, I'm going to look for the next entry reason. And if I get another entry reason at a higher level, then I'm going to take that entry reason again and play for another extension down. There's no wrong or no right answer. It's all up to your trading style and your trading philosophy. But that is the mentality that you have to have as a trend following trader. You have to be willing to take swings. And the reason I bring this up is because when price action gives you a complex pullback, these are the type of situations where you have to shortly kind of, erase all the frustration and whatnot that's going through your head from that first loss and take it again. Because you'll see that after we put in our complex pullback, so this is the first pullback, this is the failed extension down, and we put in another extension up, right, an AB equals CD pattern, we got another entry signal, right? We had a nice green candle right here, so I'm going to try and make this a little bit clearer for you. We had a nice green candle right here. We had an inside bar, right? Two inside bars, technically, well, two inside bars in within the bigger mother bar. And then we had a lower low, lower close, which could be used as your secondary entry technique and your chance to trade it down. This is also a Fibonacci inversion trade, but where, without going in too much detail, because it's a sneaky little sucker, but the Fibonacci inversion trade is basically a way to trade like a fake out in the trend. So I'll just draw on a few fibs. For example, we'll take Fibonacci extension backwards, swing low to swing high. You can see that there's a 1618 Fibonacci extension, and then Fibonacci retracement, swing high to swing low. There's a 618 Fibonacci retracement. These two golden means, the 1618 and the 618, are the level that we're looking for as far as that fib inversion goes. We also want that, or also me personally, I'd prefer that to line up with structure as well, but that's an added bonus. So again, as a trend following trader, very important to understand, like, hey, I took this loss, I have to shake it off and go for the next loss. Now, or go for the next loss, hopefully the next loss, but it could be another loss as well. You never know. But the thing you want to remember is this, right? If we're looking at this just from a risk perspective, right? And a lot of this will depend on kind of your risk profile and how you take risks. But if we're looking at this initial trade, which was the double top, I'm looking on the range bar charts right now, but I'm going to draw it on the minute chart, which was at 90.20s, right? So initial trade was right here at 90.20s. Again, keep in mind, we're looking at this on a range bar chart, so our signal was a little bit different. I just want to show you the minute chart because it's a little bit cleaner. Our bigger stop loss was 90.31s, right? So about a 11 pip stop loss, something that looks like this, right? Boom, we'll thicken that up some. We'll make that red for risk. Give me a few seconds to get this in. While we're doing it, you can hit that like button on the video, right? We're looking at a loss of about this. Now, we're looking at our secondary trade, where the secondary trade, the entry was right here at 90.17. Same type of targets, right? You can take a traditional target or a conservative target at the lows right here at our VS1 level. Boom. I'll also put in a secondary target. We know the big target is a full kind of continuation and hold, but our bigger target was that 127 extension, which if I remember correctly was at about 89.84. So that's going to be right down here. So let me just copy and paste this as well. 89.85, we'll just say it's that. Now I want you to look at your reward from the second trade, right? Reward from the second trade, whether it's this one, the small one, conservative, or the big one, aggressive. I want you to look at your risk from the first trade, and I want you to compare them and ask yourself this question. With the second trade, although it was scary, although it was uncomfortable, right? Because it increased our potential reward, because we had a deeper retracement, a deeper, cheaper price point, I guess you can say, we actually got more out of the trade. And whether you're looking at the conservative one, whether you're looking at the aggressive one, whether you're still holding it to whatever that level we're looking at, 88 flats or 88 50s, you've already made up for your loss. And that is what trading is about. Trading isn't necessarily, especially if you're a trend trader, you're probably not going to have a great win percentage, meaning you're probably not going to be like a 70-80% trader. Typically and traditionally, trend traders have lower win percentages. The difference is trend traders are really good at managing their risk, and they ensure that their wins not only make up for one loss, but in many cases make up for multiple losses. So wanted to come in and bring you that. Thought it was a cool lesson, especially given the topics we've been discussing here lately in the live room and discussing here on YouTube. Do me a favor, if you like what you see, hit that like button, leave any comments or questions below. And if you're interested in joining us in the live room, we run it every Tuesday, Wednesday, and Thursday. It is available as part of your risk-free trial membership over at tier1trading.com. I say risk-free because there's no sneaky auto bill, there's no sneaky subscription stuff. You just get on the platform for 14 days. You can hop in some live sessions. You can take some courses. You can talk to a great community of traders. You can download some software and probably do a whole bunch of other stuff that I forgot about. So I'll see you guys over on the platform, www.tier1trading.com. And until next time, plan your trade, trade your plan. Take care.